Our first speaker is Jun Bei Liu, portfolio manager at Tribeca Investment Partners. Since taking over sole responsibility for managing the Alpha Plus Fund, she has quadrupled assets under management. She is a passionate, motivated, and dedicated investment manager, having built an 18-year career at Tribeca, starting as an equity analyst in 2005 before taking over the Alpha Plus Fund in 2019. Today, she will be talking to us about Australian equities and its opportunities. Welcome, Jun Bei.
Thank you, Angelina, and thank you very much for having me. Always such a pleasure to be speaking to investors about, what I love the most and passionate about, which is the share market, Australian market investing. 2024 has been an interesting year, and very much like 2023, but better. 2023, we're really worried about where interest rate was going. The fear was that inflation was never going to come off, was hitting double digit, and interest rate will eventually turn all the economies, global economies, into recession. Now, 2024, when I say it's a better year, simply means that, on the economic front, we didn't hit recession, nor has many other economies hit recession. If anything, economy actually is showing its resilience. In a way, it's a little bit annoying for the policymakers that they feel the policy is not working, but we certainly is seeing encouraging signs that inflation is on the way down, albeit slower than anticipated. So economy holding up okay. We've got the policy interest rate is on hold for many months now, and our view is, although there is a small chance for the hike, but our base case is that interest rate will not move this year, and the next move is down by next year, 2025. And then on the policy front, obviously in July we're hitting the tax reduction for many households, so that will support our economy. And at the same time, some of the tourism numbers will continue to support our economy, combined with the iron ore and the like. So economic front, things are looking good. That has been very, very encouraging. Now, aside from the economy, in terms of the share market itself, we all know share market sometimes from a outside investor, I guess, for an investor that not following the market day to day or minute by minute like myself, you often sometimes wonder why share market move differently from the economy. Shouldn't the consumer slow down and a lot of those corporate talk of slowing down in the economy, even though not collapse but slow down, shouldn't that affect the share market? Instead, the share market keeps moving higher. Look, the share market always look forward 12 months, so or even beyond, somewhere between 8 to 18 months is what share market is trying to look forward to. And what we can see in 12-month time, we would have had the clarity on interest rates, and by then interest rate will be cut, and by then our economy would have pulled through a transition period where an overheated economy needed to slow down, and our inflation would have been fallen well in control, or well in the band of all the central banks' expectations. We would have had perhaps China coming out of its slow recovery. Things might get just a little bit better there. So in 12 months, the world looks like to be a much better place than even now it is today. And today was a recovery from the previous few years as well. So the share market perspective, if we look forward, things aren't too bad. That's why you're seeing share market continue to move higher, although Australian market has been left behind a little bit compared to the global, say the Nasdaq. That's partly because our heavy resource focus and resource focus sort of index weights, resources have gone through a pretty tough period because China's recovery is a little bit slow and global economy is cooling somewhat. It is giving that temporary pause before the next leg up, if you like. So for the next 6 months, we're pretty positive. We've been bullish the share market, and next 6 months will continue to be pretty bullish the share market. Now, for the time being, we will hit a little bit of volatility. It's simply because as we're heading into August, the Australian full year reporting season for financial year 2024, we will have a little bit of earning adjustments. As we talked about before, economy was pretty tough. It is slowing down, with particularly the consumer-facing companies like the retail, like the services businesses will be a little bit tough. But my view is that the expectations not high, but we just need analysts to reduce the expectation for the next 12 months, so we can rebase, and then we can grow from a rebase level. For August, we will have a bit of volatility. Earnings will be downgraded somewhat, but that is really just to have a healthy pullback for the share market, and particularly for active investors to have the opportunity to buy back into the market, because we believe from here on, over the next 6 months, you will see a fantastic buying opportunity, and that will be the point where it is the starting point for the next leg of bull market for the Australian market, as our earning wash through its weakest period, and as the earnings multiple sort of trough, and as the interest rate sort of peaks and then heading lower, in 2025. So our view is pretty positive for this market. Might be a little bit choppy for active investors. We remain very, I shouldn't use the word excited. We like markets that's a little bit volatile, particularly around earnings season. We always believe this is when you find your highest quality companies, and take advantage of the price sort of movements. In this market, we are seeing quite a lot of opportunities at the moment. So, hanging tight and take advantage of the market opportunity, and then we will see this reporting season.
Great to see you, Jun Bei. Do you have time for 2 questions?
Of course.
How does long-short strategy take advantage of the market opportunity given this backdrop?
Look, the long short is actually very interesting. When you can do long, that means you buy the high quality companies, and like a traditional investor. At the same time, you can short the companies where you believe the share price is too high. You can take advantage of both sides of the research that we do, and combine it. Couple of things that it gives you sort of that leverage to benefit from a volatile market is that we can jump in at any time, regardless what the market flavor of the day is. We can buy growth company in the period where no one wants to buy growth company, because we can short other companies of similar characteristics. So that's number one, giving us the benefit of ability to jump in at any market opportunity, any point of the cycle. It gives us the opportunity also to outperform in any market sort of cycle. So whether it's an up market or down market, or whether it's risk on market, risk off market, we have shown our ability to outperform consistently with our long short capability. Now, as I touched on earlier, the shorts, sometimes if you find a high conviction short, a company's share price is mispriced in our opinion, sometimes we find these can add to the return quite substantially, because simply there are just not that many long short managers who has been around for this long here in the Australian market. So it is a sort of very niche space where there are not many competitors around, and we have found that given our experience and our return in the Australian market, we have certainly found many opportunities on the short side.
Where do you see the opportunity going forward?
Yeah, so over the next 6 to 12 months, we're seeing quite a few, thematics, but will play through the markets. Well, first of all, we will have the, let's talk about China. So China's slowdown has been quite drastic for a lot of our mining businesses, and its turnaround has been problematic, has been slow, but regardless, we are seeing green shoots of things getting better. But particularly its consumer, its travel services, as you expect, economy coming out of COVID lockdowns. But it's other parts of the economy, such as property and the like, it is now at least showing stabilization given amount of policy stimulus the government has thrown at those markets. So we are seeing early signs things are getting better. Consumer in China is still very pessimistic because they're heavily leveraged to the housing, they're heavily leveraged to the share markets. But the health of their consumer is actually not too bad. They say they have very low gearing rate. Their interest rate has gone down instead of gone up compared to our consumer, and then they've got no inflation problem. So with that combined, the sentiment will turn. It just requires a bit of time. So we're looking forward next 12 months. That sort of space is actually looking quite interesting. So resources company certainly looks like, given its underperformance in the last 6 months, it certainly looks like it's a place where you find quite a lot of return at the moment, particularly for businesses that large diversifies that owns some of those future-facing metal, if like copper, for example. So BHP itself, having walked away from Anglo-American bids, share price has fallen quite steadily more recently, and it presents quite a meaningful opportunity for investors with actually pretty low risk exposure by buying the China recovery, buying the copper exposure. So we see that there's good opportunity. We're also seeing another part of the economy might be a little bit late, might be a little bit early, but it's certainly something to watch. We believe that consumer-facing companies like the retailers heading into this reporting season will experience a lot more volatility because of the interest rate cut is not coming through this year, because earning might be too high, because our consumer is in a tough spot at the moment. So so I do think that retailers will experience pretty tough earnings downgrade this reporting season, and for the next 6 months as well. But this is your opportunity really to take advantage and buying some of those quality retailers, because we do believe with the tax cut, with the interest rate cut on the cards, into next calendar year, these businesses will rally aggressively. And it's really just, average your way in and find opportunity and find the best quality companies and buy in those space. And putting these aside, we also believe in having exposure to the AI growth globally. It is a real thematic, and there is limited exposure within the Australian market, but we have found quite a few larger businesses that have direct exposure to those areas. Some of the lower risk ways to play it, such as Goodman Group, that has a huge pipeline of future growth coming from the data centers. We've got NextDC. These are some of the well-known names, but if you filter down, there is a couple of other smaller names they can look into. So for us, the portfolio is a little bit of everything, but we do believe the cyclical part of the market will do better. And at the same time, you've got to have exposure to some of those long duration growth companies.
Thanks, Jun Bei.
Thank you so much for having me, Angelina.